Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us today. My guest is Peter Cardillo. He's the Chief Market Economist at Spartan Capital. Peter, welcome to the show.
Good to be back.
All right, Peter, give the new viewers some background on you, and then I'm going to dive into what's going on these days with the markets, the trade tariffs, and things of that nature.
Sure. Actually, I'm the Chief Market Economist at Spartan Capital Securities here in New York, and of course we are a small boutique firm that basically caters to all types of traditional investments. And so we have a great team, a great management team, and the company is rapidly growing. As I said, we're right here in the heart of Wall Street, and I've been around for over 50 years, registered for about 47, and I am a worldwide market economist. Commentary reaches every part of the globe.
Great. All right, now that we've got a pretty good idea of who you are, what you do, talk to me about your take on the markets on a macro level.
Yeah, well, I think, from a macro standpoint, we're doing pretty good. The economy probably this quarter is going to grow over 3%, possibly as high as 3.25%. Obviously, some of the implementations of tax cuts and certainly less governance by the regulators is actually helping the economy, and that's good news. And so whether or not this will be interrupted by a prolonged trade war, which can turn quite nasty, then I think, we'll probably see the stock market continue to do well, at least for the balance of the year.
Now, let me get into some of the questions, because we're talking apples and apples when you and I get together. Quite a while ago, there was a director of the Federal Reserve. His name was Alan Greenspan, and his famous statement was unbridled enthusiasm. Do you think that they have the powers that be, and I'll just leave that in a generic term, have gotten a grip on what they're doing so that they can guide the economy in a more controlled fashion, and we're not going to get into a position of uncontrolled growth that leads to negative impact in the end run?
Yeah, I think that's a great question. And, the answer to that is, I think that the Feds now, and I'm assuming you're referring to the Feds, obviously, yeah. They are, I think they're doing the right thing. Powell recently said, look, we can't afford for the economy to overheat. And he's correct about that. And when you have low taxes, as we have now, especially at the corporate level, it's quite easily to overheat. The missing puzzle, however, and I still can't figure it out, to be honest with you, is why we haven't had wages kick in that would give us inflation. So to a certain degree, that's pretty good news. And I think the Fed is dealing with that. I think the Fed is probably going to raise interest rates by at least 2 more times this year, which means another 50 basis points. And that's probably would curtail the possibility of the economy overheating and inflation getting out of hand. Now, talking about inflation, we are going to get a glimpse of inflation news this week. Tomorrow, we have the PPI. I'm expecting that to be up rather substantially. And the reason for that is we're finally going to see transitory inflation take hold. Why am I saying that? Well, look at the price of oil. We're almost at $75 here in New York, almost $80 at Brent. That's being passed on to the consumer. And we're seeing that at the gas pump. I don't know what gasoline is selling in your part of the world, but I can tell you that in our part of the world, it is now over $3 a gallon. And I think we're probably headed for maybe 3.25, 3.5 by the end of the summer.
Okay. Now, let me drill down on that. Do you see that these trade tariffs that we have going on with China, their pushback is going to add to an inflationary scenario here domestically, or is it not that big of a deal in the overall scheme of things?
Oh, no, I think it is a big deal. I think, as I said before, if we get involved in a prolonged trade war, and if these tit for tat tariffs continue, we could be in serious trouble. Trump, before he embarked on this, said that they were easy to win. Well, I dispute that. I don't think they're easy to win. It depends who you're fighting with. Now, we might get some concessions out of Europe. The EU is probably going to make some concessions, especially in the automobile world. And the reason for that is because they're, having difficulty growing from present levels. And so they do not want to disrupt their growth. They can't afford it at this time, especially with the fact that you have, a new breed of governance in certain countries of Europe, such as Italy. So they are going to make some concessions. I'm not too sure the Chinese will. And you might say, well, we're stronger than the Chinese. We have a bigger economy than China. Indeed, we do. But we're not a controlled economy. China is a controlled economy. And they're not as free as perhaps the press makes them to be. And so that means they can endure probably more economic hardship, that is, their people can, as opposed to we can. And so I think this could be a fight that goes on for some time. And that's not good news.
I get that. Well, in light of that comment that you made, that statement that you made, do you have pockets of opportunity when it comes to industry sectors that you're looking at that you see long-term growth? I'm talking about investor concepts here versus trading concepts.
Well, I think, in my own personal opinion, and I can't elaborate on sectors, as you know, but I can tell you this, that every portfolio should have a defensive strategy, whether it be gold, whether it be equities that might be defensive. I think that's, only common sense. And that's the way you can protect yourself in case there is a real downward trend in the stock market.
Do you see that? Let me stop you there. Do you see that coming in the near term because of these tariff wars that are going on right now?
I don't see that in the immediate future.
Yes.
Could that come if a prolonged trade exists? Absolutely. And especially, if we go towards flat or negative growth.
It seems to me that let me circle way back into the conversation because you were talking about wage inflation not really showing up yet. And correct me if I'm wrong, I'm just trying to stay on page with you, is I see greater communication between the public and private sector occurring now than in previous administrations, so that the communication of what the public and the private sector is doing comes together in a more dovetail fashion than it has in the past. Are you noticing anything like that, or am I just way off base?
No, I think to a certain degree you're correct, but I also think one of the reasons why we don't have wage inflations is simply because of the fact that the shortage of workers hasn't really hit the employment market. We're seeing that happening a little bit, but it's not to the extent where employees would be held hostage employers would be held hostage by employees. We haven't gotten to that just yet. Is it on its way? If the labor market continues this way, I think so.
Okay. I just want to drill down on that before we close out on this. When you say we haven't gotten to the shortage of labor yet, I wanted to make sure that I'm clear on what kind of
skilled laborers. And one of the reasons for that is because of technology. If this economy would be enduring what it is enduring now, 20 years ago, wages would be through the roof. But we're not because of technology. But there's a certain stoppage gap to that too. We haven't reached that yet, but when we do, I kind of think that we will see explosive salaries.
Got it. All right, Peter, any last words before we part ways today?
Yeah, I think the stock market will continue to do well. However, any prolonged trade war would mean all bets are off, and we could possibly get into flat to negative economic growth in 2019.
Thanks, Peter, for being a guest on the show. Appreciate it.
My pleasure.
You've been watching CEO Money with Michael Yorba. Don't forget to follow us on Facebook and subscribe to our YouTube channel. We'll be back with more great content for you right after this.